Welcome to Fairport Flash, the monthly economic update powered by the Fairport investment team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to Fairport Flash. My name is John Silvas, and I am the Chief Investment Officer for Fairport. Today we wanted to talk about the top issues concerning the markets and the economy that matter to investors, our clients, heading into 2019. So let's jump right in. I think it would be an understatement to say that 2018 was a volatile year in the equity markets. Following 2017, which didn't see a decline of 3% or more, 2018 saw two declines of over 10%, with the most recent one in December, which dropped 19.8%, nearing the definition of a bear market, which is 20% or more, just missing it. We think volatility will continue in 2019. If you go look at the last 2 months, in fact, if you look at the fourth quarter, the S&P 500 index was down about 13.5% for the quarter. The ACWI, or the All Country World Index, which is a global equity index, was down 12.7% for the quarter. More specifically, if you look at December, the S&P was down 8.8% and the ACWI was down 7.2%. Basically the worst December since 1931. However, that was followed by the most recent January, which was up 8% on the S&P, and the ACWI being up 7.8%. The best January since 1987 over the last 30 years. So with 2019 off to a historic start, we can't dismiss the fact that we may retest the lows of December. Historically, the pattern is that you see a pretty big decline in the markets like we saw in December. You see a bounce. You tend to see a retest of that low, which the case would be December 24th, and the markets tend to then bounce off of that with more vigor and continue the uptrend going into the following months. With the S&P up 15% from the current Christmas Eve low, it's likely the market will take some time to consolidate. Doesn't mean it has to. The further we move away from the lows, the less likely that may be to happen. That being said, we do think we'll see positive returns for the equity markets in 2019. History is kind of on our side on this. We're in the third year of the presidential cycle, which since 1942 has had an average return of 17%, all those being positive. In the year following the midterm, which we mentioned before in the past, which has been positive 100% of the time since 1950, which is an average return of around 15%. And finally, over the last 45 years, with the exception of the tech bubble in 2000, a negative year in the markets, which we saw in 2018, is usually followed by a positive year. It's rare that you see two negative years in a row, especially without a recession, which we don't currently see. So we definitely think history is a tailwind. Also, I think corrections in an expansion, meaning not a recessionary year, tend to see a positive bounce off the lows. This has happened 7 times over the last 40 years with a decline of average about 19%, which is right in line with what we saw in December. And then you see a bounce off that low of about 25% 6 months following that. Now, I'm not sure where the low is in, but we seem to think that that may be the case. Also, from the fundamental side, we think there's a positive tailwind as well. First part would be, we think earnings will be positive in 2019. As we near the end of the fourth quarter earnings cycle, U.S. companies, as represented by the S&P 500, are doing pretty well. In fact, they're doing better than expected, with the year-over-year expected returns for the quarter to be about 16% and revenue growing about 5%. So 2018 will see a double-digit year in earnings with likely growth of about 20% for the year. We expect 2019 to be a good year as well, not to that degree, but probably see earnings growth of somewhere between 5 to 8%, which should be a positive momentum for equities going forward. We also think the dollar will decline in 2019. We saw the dollar decline in 2017, which was a positive for earnings and international equities. In 2018, we saw the dollar increase, which was a negative for earnings and a negative for international equities, especially the emerging markets. We think that will reverse trend this year, and we think the dollar will actually decline in 2019. We still think we'll see domestic equities do better than international equities, especially in the first half with a lot of the uncertainties out there, which we'll talk about in a minute. However, we do think emerging markets will be one of the beneficiaries from a weaker dollar and actually can be one of the better asset classes. We think it can go from being one of the worst in 2018 to maybe one of the best in 2019. In the short-term horizon, though, we do actually think there's 3 issues on the horizon, especially for the month of March. We have the Brexit issue, which has a March deadline, and not much progress has been made. So if they actually have a hard exit, that's probably going to be disruptive to the equity markets going forward. The second one would be the trade deadline, which I think everybody's well aware of. So we have the trade issue with China. There was a March 1st deadline. I know there's been a lot of progress made so far, but we'll keep an eye on that. And we think it may not be a deal, but I think if there's some type of progress going forward, that could be a positive outcome. And then the last one, which goes back to the government shutdown from a few weeks ago, is the funding for the budget in what is now fiscal year 2019. We think that, combined with a debt ceiling issue, which is also going to be coming to a head in March, we think the combination of those two things could also be a headwind going into the next few weeks. So we don't see a recession in 2019. That's one of our base cases. One of the concerns early in the fourth quarter was that the economy was slowing, and maybe slowing rapidly. And markets started to bake in on what they thought would be a recession in 2019. That is not our view. First, 2018 is likely going to grow around 3% GDP growth. Fourth quarter is probably going to come in around 2.5%. Some of the numbers, because of the government shutdown, have been delayed, but the Atlanta Federal Reserve, which does a GDP Now forecast, is about 2.5%, and they've been pretty accurate over the last few years, so that's our best case for the fourth quarter. 2019 will definitely be a slower year, probably 2% GDP growth, and probably 3% GDP growth globally. But none of the economists out there, especially on Wall Street or at the Federal Reserve banks, are calling for a recession in 2019, and we think that's true. But we are seeing some data slow. Housing starts has definitely slowed. Leading economic indicators have been slower for the last few months. But on the positive side, the job numbers, so job growth has been positive both in December and January, with about 250,000 jobs created for both months, which is well above average. And manufacturing looks like it's bouncing back in January. So again, we don't think there's any signs of a recession in 2019. We do think there'll be some weakness overseas. China's definitely had some issues with their GDP growth. It's down to about 6%. They've done a lot of monetary policy easing recently, and they're definitely putting a lot of liquidity in the system to try to boost growth going forward. And as far as Europe goes, Italy is now officially in recession, so that could spill over, especially with some of the issues in Brexit in the next few months. So 2019 is not as good as 2018 from an economic standpoint, but we think it'll do. And so why is that important? Because we think if global economic growth is positive, we think global earnings will be positive. And if earnings are positive, that tends to be a pretty good backdrop for the global equity markets. So if global growth changes materially and we actually do see a slowdown and maybe even possible recession, we'd have to reconsider some of our base cases, but we don't think that's going to be the case. 2% GDP growth in the U.S. is, with firm job growth and inflation very low, is a good enough backdrop, we think, for positive equities in 2019. One of the last things that we're going to keep an eye on, the Cleveland Federal Reserve here in our hometown uses a model for predicting recession, and right now it's only at 24%. That's slightly up from 20% a few months ago. Any reading above 40% would predict a recession in the next 12 months, and we don't see that currently. Another thing important for investors to remember that current valuations, especially after the market correction, are actually pretty attractive, the best we've seen since 2013, both on an absolute and relative basis. So we think that's a positive heading into the new year. For those that have followed us, we have always used the forward price to earnings ratio as a way to value the market, especially the S&P 500, relative to its historical average over the last 25 years. It's been trading above the long-term average of 16.1 for the last few years, so you could argue that we were in fair value, but we thought both with low rates and low inflation, it was still attractive. But at the end of 2018, we saw those multiples actually drop to 14.4, the lowest we've seen since 2013. So from an absolute basis, we think equities look attractive, and we think they're actually undervalued. Citigroup did a study recently, and history would show when the price to forward earnings multiple is trading between 14 to 16 times, the 12-month returns are actually positive, about 16%. So we think we're kind of in that sweet spot right now. Another way to look at valuations is on a relative basis as stocks look to bonds. And we still think stocks look attractive relative to bonds. So we use the equity risk premium, which is the inversion of the price to earnings ratio and minus the 10-year yields, which is widely used in the industry. 10-year rates dropped 60 basis points in the fourth quarter. So the equity risk premium actually went up. So it's about 332 basis points at the end of 2018. And a recent study by Strategas would show you usually when you're over 200 basis points, the 12-month forward returns in equity markets are about 14% on average. So again, we would favor stocks over bonds when the equity risk premium is above 200 basis points. So the direction rates will be important going forward and something we'll also keep an eye on. The last issue we want to address that we at Fairport think will affect markets in 2019 is the shift or the shifting monetary policy from the Federal Reserve. In October, Federal Reserve Chair Powell made comments about monetary policy being on autopilot. We think that was kind of where the start of the decline or the correction started. Now, in early January, his comments, and again last week at the FOMC meeting, he's taken a much more dovish tone. What could be driving that could be the comments from the president. It could be the slower economic data that's come in. It could be the decline in the 10-year yields materially, which have dropped since October. I think what they're looking at is the yield curve, which is the difference between the 10-year Treasury and the 2-year Treasury. and that has narrowed quite a bit. I don't think they want to invert the yield curve, which historically has been a pretty good indication the recession would be on the horizon. I think other issues that they're taking into consideration is the trade issue with China, which has probably dragged on longer than they thought, and also the recent government shutdown, which has caused some uncertainty. So since the policy has shifted in the last few months, back in October, the Federal Reserve's forecast for interest rates was 1 increase in December, which they definitely did, and 3 to 4 increases in 2019. Now in January, after the increase in December, they'll look at maybe 1 or 2 increases in 2019, and most likely not till the second half of the year. We think that's a positive for risk assets, especially equities. That gives us further evidence of a positive backdrop for equities in 2019. So heading into the new year, we think volatility will remain elevated. We think there'll be a positive equity returns, mostly driven by earnings, which we think will rise between 5 and 8% in 2019. We don't think there's a sign of any recession. That's our base case. We think valuations are attractive both on an absolute and relative basis for equities, and we think domestic equities will probably do better than international equities. And we think the Fed's going to be much more accommodative, shifting monetary policy from the autopilot, which he mentioned before, to what we think is more data dependent. As always, the Fairport investment mantra is to remain focused on the long term and what matters to investment success in the years ahead, not just the next few weeks or months. That reminder brings us to the close of today's Fairport Flash. Our passion at Fairport is inspiring families, our clients, through everything we do. We hope our podcast inspires you to be in touch with your Fairport advisor if you have any questions about how any of today's general topics apply to your own portfolio. Bye for now. Look for the next Fairport Flash in about a month.